Hello, everyone, and welcome to another session of Expert Insights Live. Uh, Before we start our session, it would be really nice if people can confirm whether they can hear us, whether they can see us. Just probably drop a hi in the comments and let us know where you're joining us from so we know. And yeah, what time zone are you in? It's pretty late here in the UK. What time is it where you are, Jason?
We got 11 a.m. in Mountain Standard Time here in the US.
Okay, it's 6 p.m. on a Friday over here. So yeah.
You're dedicated. Thanks, Tushar.
Well, I wasn't fetching for compliments, but thank you for that. Uh, yeah, as soon as we start receiving at least one comment so that we know that we're not alone, I can see that there are a lot of people joined in. But okay, well, there are a lot of people. I can see that in the numbers above. So, Jason, why not let's start with an introduction? Can you introduce yourself?
Yeah, sounds good. Um, I started my career about 20 plus years ago, and I started off as a hedge fund trader. I was then a derivatives trader in Chicago, moved to market risk, quant analytics, credit risk, quant analytics. Then I moved to London and worked in the same derivative space. Um, Moved to Singapore and built a technology organization for a agricultural trading business. Then I went through to a metals trading business at Rio Tinto in Singapore. So for our friends in Australia, Singapore, etc., you'll probably know Rio Tinto, maybe even the UK as well.
Mhm.
Moved back to the US about 3 years ago with Amazon Web Services doing big data analytics implementation in capital markets. And last year, I joined Anderson Consulting as their head of AI and advanced analytics, all the while still actively trading. Started PyQuant News in 2015 as a way to track all the interesting bookmarks about Python and quantitative finance. And 10 years later, which is crazy to me, 10 years later, still running PyQuant News, do a newsletter, do a course, etc., and happy to report almost 1,800 people have gone through the algorithmic trading course. And I've got some content on that later, Tushar, that we can share, coupon codes and
Ye-
things like that if folks are interested.
Yes, that would be amazing. Thanks a lot, Jason. So, just a few quick things for people. Oh, firstly, Danny on LinkedIn says that it's 1 p.m. in Boston. I believe that's Eastern time, 5 hours behind UK.
Yeah, that's right.
Yeah. And okay, so there are people who can hear us. That's a good confirmation. Georgie says that, oh, he's already commented hashtag packed. Yes, there is a ticker going on at the bottom. So you can see that there is an opportunity for two people to win a 50% discount voucher for the best selling live workshop that Jason has been running. The first one was amazing. It was so good that we completely filled up the space and we had to do a second cohort. So yeah, this is the second cohort. We're doing it second time all over again. So if you want a 50% discount voucher, please comment hashtag pack as Georgie has already done. We'll do a couple of raffles. Uh, and feel free to ask any questions that you have in the comment section and we'll pick it up. So since I've already spoken about the cohort two, so can you tell us what the workshop is about, what it is, if you wanna show it up or yeah, whatever it is, just inform
Yeah,
people.
happy to. So I spend a lot of time helping beginners
Hmm.
learn how to use Python for all things quant finance. And that is everything from, pricing, derivatives, but most of the time I'm spending on algorithmic trading because that's what most people are interested in. And I think that's what we'll be talking about today. And I teach a course. I have a course that's 20 or so hours worth of content that takes people that are interested in getting started with Python for quantitative finance and algorithmic trading, takes them through a lot of the conceptual frameworks that you need to understand to get started with this stuff. But it's very practical. So I'm not just going through slides and showing some theory. I'm actually showing you the Python to execute what we talk about.
Yeah.
And the course with Packt or the workshop with Packt is a very condensed version of that. So I'll take folks through the process of, like very quick mental models on what is edge, what is alpha, how to think about edge, how to think about alpha, and then how to start using Python to actually build a trading strategy. And by the end of the session, which the last session ran almost 5 hours after Q&A.
Yeah.
But by the end of the session, folks will have code to run a real life algorithmic trading strategy. And this cohort is different because the first one we did on a Saturday when the market was closed. So it was a
Yeah.
little underwhelming because we couldn't actually get trades in the market. This one will actually
Yeah.
be live trading. So you will walk away with all of the code templates that you can
Yeah.
just start running and actually get a live trading strategy going.
Oh, yeah. I'm actually showing it on my screen over here. I
Yeah.
hope everyone else can see it. You, after doing everything, the strategy and all of it, you're going to take them into live trading, which is amazing.
Yeah, it's pretty robust, and for $215 or whatever Packt priced it at, I consider it a pretty awesome value. Just because you've got a practitioner teaching it, you walk away with all this code, and this
Mm.
stuff actually works. It's a trading strategy. We're trading now, and it's actually quite profitable.
Yeah, and God forbid if you don't win in the raffle later today, there's still a chance to get it for 20% off. Uh, yeah, I'll just try and post this link in the chat, and I'm not sure if I will be able to, but yeah, later on, Jason will be making a post about it. So if you follow me or if you follow Jason, just keep an eye out. We will post a link out.
Great.
So, okay. So, well, we'll wait for people to ask their queries, and I can see a lot of people have started commenting as well. Thank you, Vikram. All the best, and all the best, Ricky. So, yeah, if you want to win a voucher, please feel free to comment, and we'll wait for your queries. And Jason, I have a lot of queries while I'm waiting for people. Don't worry, I'm not going to ask you about trading and overnight success strategies. Although, yeah, that would be amazing to get. But yeah, so what's the biggest misconception that people have about algorithmic trading?
Yeah, it's a great question. There's many. There's a more conceptual one, and then there's a very practical one. I think the conceptual one is that you need a lot of very complex strategies to be
Mhm.
successful. And the purely by the definition of what algorithmic trading is, it's using algorithms to make buy or sell decisions against some level of assets, right? And there's lots of different ways that you can express that perspective. And whether it's a monthly portfolio rebalancing strategy or an intraday trading strategy, they're all using algorithms to trade. And as long as you don't get caught up in a definition of what algorithmic trading is, there's lots of different ways that you can use code to
Mm.
assist in your ability to execute. I think the other notion that it's all high frequency trading, right? And that you've got these hedge funds that are trading on 10 millisecond intervals. Yes,
Yeah.
there are funds that are doing that, but that's not the game we're competing in. We don't have to play that game, nor can we. We don't have the infrastructure to compete at that level. The best execution we can get from our normal computers is probably 200 milliseconds, and
Mm.
there's no way you're competing on the same game. So there's this misconception that you need to know C++ and all these really low level languages and program chips and all these crazy things to to compete, but we're not competing in the same game. Like, we are competing on an entirely different playing field. And that's what I talk a lot about, is how to use Python, which is arguably slow, right?
Yeah.
To use algorithms and statistics to make trading decisions. A third misconception is that we're sitting here doing technical analysis. Now,
Mm.
I have traded technical analysis for many years. Personally, I was not successful doing it. I know people that are successful trading technical analysis. But if you're just getting started, there's a very good chance that if you're making money, you're just getting lucky. And people don't want to hear that. But there's very, very little edge in technical analysis strategies because
Mhm.
every single retail trader on earth has access to the same data, has access to the same Python programming languages, has the same access to the same laptop computers, and there's only finite number of different edges that will exist across all of those participants all trying to get the same trade. So there's ways that we can, if we want to talk about that later, if folks have questions about how to, we can go deeper into that. But that's the third thing, is that, this concept of technical analysis will lead to some long-term sustained edge, which I don't necessarily think is true for most people.
Hmm.
So there's three right there. We can dive deeper into any one of those three if folks want to hear.
I would love to hear at least about
Okay.
the first and second one.
All right, let's talk about this technical analysis thing. And
Yeah.
let me first define what I mean by edge, okay? So I'm going to give you a thought exercise, and I talk a lot about this in the workshop that you talked about, Tushar. I'm going to give you a thought exercise. You can play a game with me, and the game is this. I will give you $1,000 if you roll a 5 or 6 on a dice. Okay, $1,000.
Hmm.
So my question for you is, how much would you pay to play this game? So we got to think of the probabilities. Like the probability of rolling a 1, 2, 3, 4, 5, and a 6 is 1/6. Okay.
Yeah.
And how much money do you make if you roll a 1? 0, 2,
Yeah.
0, 3, 4, 0. How much money do you make if you roll a 5 or a 6? You make $167, right?
Hmm.
16.7% probability.
Yeah.
So what's the weighted probability, which is 167 plus 167? It's about $334. Okay. So if I were to ask you, how much would you pay to play the game? Your answer should be anything less than $334.
Mm.
That's an edge. And
Yeah.
our job as algorithmic traders is to find assets that are trading less than fair value. And of
Hmm.
course, fair value can mean anything. It could mean a statistical estimate of price. If you're an options trader, it could mean some implied volatility. But that's the game of algorithmic trading. And that is the biggest misconception that folks have, is like, what does it actually mean to get an edge? And if you have an edge, that means you're persistent in making money in that mispricing. We're looking for asset mispricings, basically, in the market. And my hypothesis that I will offer to you is that you're not going to find market mispricings simply by technical analysis. You're
Mm.
applying filters on top of normally random price data.
Yeah.
Therefore, your filter is random. So that's the kind of mental model that I talk about in the workshop. That's the mental model I talk about in the course. And this is the basic premise, the foundation of how to think about algorithmic trading. And we use Python, we use data to try to find ways to measure those asset mispricings,
Mm.
as opposed to just putting moving average and RSI and Bollinger Bands on top of charts and using our mind and trying to use our gut feeling about when there might be an opportunity to trade.
Yeah. It's all data backed decisions. I
Yes.
mean, all right. So Jason, we are still waiting for questions. People, if you have any queries for Jason, feel free to comment them. And while we're waiting for them, I'll ask my questions. So, from your experience, what differentiates traders who succeed with algorithms as compared to those who don't?
Yeah, it's a good question. These are all really good questions, Tushar. So I'll stop saying good question.
Thank you.
There's kind of a couple things, right? So there's people that have experience in the markets and experience with Python and computer science and trading, et cetera. And then there's people that are brand new. So it kind of depends on what your background is. But in general, I would say that people try to overcomplicate things.
Yeah.
I've been teaching this topic for many years and have gone through many, many different students. And I will always find those that are trying to pump prices into deep neural networks or using hidden Markov models or some very fancy math, very fancy statistics. You don't need fancy math and fancy statistics. A better perspective is to find an edge and express your view in different ways. And let me unpack that in a second. What makes the most successful algorithmic traders is creativity. And
Okay.
it's people that are willing to kind of do the research, not technical research, but like actually read about the economic links between oil and refiners, or energy producers and energy consumers. Like these economic links in the economy drive relationships,
Yeah.
and occasionally those relationships break. And that offers alpha events, opportunities for algorithmic traders to detect those patterns and trade them. And when I talk about expressing your views in different ways, let me give you an example. So one of the trades that I talk a lot about is this crack spread. And it's a funny name. Has anybody heard of the crack spread? Just in the chat, just put a 1 in the comments if you have heard of this concept of a crack spread, okay? Put a 1 in the chat if you have heard of this concept of a crack spread, okay? So I know there's a delay, so I'm just gonna keep talking. So the crack spread is named from a cracker, and a cracker is a piece of equipment in a refinery that cracks petroleum molecules into its refined products. So you put a barrel of crude oil into a refinery, you crack the petroleum molecules into refined products, jet fuel, heating oil, RBOB, whatever. And the whole job of a refinery is to produce refined products from crude oil. So the crack spread, the name of the crack spread, comes from this process of cracking crude oil into refined products. And the crack spread is the price of a barrel of crude oil against the price of its constituent parts. So 3 barrels of crude oil will generate 2 barrels of RBOB, gasoline, and 1 barrel of heating oil, okay? So the difference between the price is the crack spread. Now, the trade is if that spread expands or increases, you would expect that the profit margins of the refinery engaged in that activity would also increase, right? Because it costs the same amount of money for input, but they're making more money on the output. Okay, so you pay $60 for a barrel of crude oil, and instead of $100 for the refined products, you get $150, right? That's an expansion of the spread. You would expect that information to be priced into the stock and the stock price to go up. Well, guess what? Sometimes it doesn't go up, and that's an opportunity for us. That's a relationship that has broken, and we want to take advantage of it. Okay, so essentially you are now bullish on the stock. Okay, that is your hypothesis. Now there's many ways to express your view. So instead of getting overly complex and trying to apply Markov models or deep neural networks, let's just figure out different ways to trade a bullish perspective, right? You can buy the stock, you can buy a call option, you can sell the futures contract and buy the stock, you can sell a call spread, you can buy a put spread. You know, there's 10, I just gave you 5 or so different ways to express the same bullish view on the underlying stock. And that's what people miss. They miss keeping it simple. So you asked me, Tushar, what separates success from failure? It's that. It's how do we find the trade and express our view on that trade in multiple different ways? Because that's all, you know, an options trade is a different risk profile from a stock trade. And a futures trade is a different risk profile from a stock trade, right? So all these are different risk profiles. They generate different P&L. So I would say keep it simple. Spend your time on the research. Now with ChatGPT and these AI tools, you can research these strategies down to the very smallest minutia and really get a good perspective on how to trade them.
Yeah, it's good to see that at least there are a couple of people who've commented. Danny Clark and Georgie, they've heard of the concepts that you were talking about.
Good.
And it was an amazing explanation, Jason. We've got our first query on YouTube. I'll just read it out. So there's someone called Brain Lacum on YouTube who is inquiring that. So Jason mentioned technical analysis don't have an edge, but what if some strategy give good backtest results? Should we implement and deploy those or not?
Such a good question. And this is the most important thing that you can take away from this conversation today is this. A backtest is not there to show you performance. Most people think you run a backtest, you get positive P&L in your backtest, go trade. That's the incorrect perspective. A backtest is there to test the statistical significance of your strategy. Okay, a backtest is used to generate data. You generate data to then statistically analyze your strategy. So in that example, you've got this technical strategy and you run a backtest and you get positive results. I would posit there is a 99% chance that you have overfit your strategy or the backtest. And let me explain why. This is a common practice and a very common failure mode, okay? So you've got a backtest and you've got some technical strategy or any strategy for that matter, and you go through the process and you end up with some P&L, and you're like, let's optimize the strategy through the backtest. So you run a brute force optimization, which is basically a grid search, and you test every single input until you find that combination of inputs that maximizes your output, your P&L, okay? What you've done is you have found the combination in a nearly random set of price data that leads to a random result, right? The Sharpe ratio, or the P&L in your backtest, by definition is random because you have fit to a nearly random set of input data, i.e. the prices. And we've already kind of talked about technical analysis does not capture asset mispricings. It does not capture a repeated pattern per se that you can consistently and profitably trade. So what you end up with is an overfit backtest. And what will happen then is when you apply that same set of input parameters to future prices that the optimizer did not see, it doesn't generalize, right? It's fit to a random set of data, and it will never see that same pattern again because the data is random. So what you're doing then is applying a set of parameters to a random set of future data, and you will typically fail in real life. And that happens very, very quickly. So that is a common failure mode. And just to bang this home a little bit, you can actually test this. And this is how you test it. It's a process of walk forward analysis. You take training data, you take 70% of your price data, and you take 30% of your price data, you split it. This is common in data science, right? And you optimize the parameters on your training set. Then you take those parameters and you apply them to your test set. And you do that over and over and over again. You can take those different sets of parameters and you can run a simple one-sided t-test, the same t-test you learn in statistics in your very first statistics class, and almost guaranteed you will find that you cannot get a statistically significant result. And what that's telling you is that if you do happen to have a positive P&L, it's not statistically significant, which is telling you you've just gotten lucky. So to answer the question is to Vrem Lacombe in YouTube is if you have a good result from your backtest, you should enter that with a lot of skepticism and cynicism. You should run through a walk forward analysis and statistically analyze your backtest results. And if you find that your results are not statistically significant, you cannot say that you have captured an edge. You have to assume that you're just getting lucky.
Thanks a lot for that, Jason. And thanks for your question, Viren Lakum. There's another comment on LinkedIn from Vikram Khatri. Vikram says that I've been an options trader in 2024 and made good money. Consciously, I decided not to trade in 2025 and stayed away. I made money not because I was smart, but I got lucky. I want to explore data-driven analysis, trying to get guidance on how to move algorithmic trading and how to get data to use. I think the last part is a question.
It's a great question. Most of the students that I teach are in the same position. They have been trading on a discretionary basis, options, stocks, futures, whatever, and they want to get into a more data-driven perspective. You really have to understand how to code, unfortunately. Whether that's R, obviously I'm a Python person. These are very accessible programming languages, meaning that they are easy to get started with. So what I would suggest is to definitely start practicing and getting your head around how to use Python. I will pitch my course to you all and talk briefly about that. Sure, if I can share my screen.
Yeah. Just a moment. Jason has actually accidentally closed his browser, I guess. We'll just wait for Jason to join back. But yeah, in the meantime, while we're waiting for Jason to join in, we'll do our first raffle. Okay, Jason is here.
Wrong button, sorry.
No worries. I was just
doing
going to do the raffle while you were not there, but yeah, great. Please share your screen.
Okay, the Zoom button on slides and PDFs. I want to share my.
Vikram says that he knows coding very well. Just
Okay. Oh, perfect. All right. Well, let me just talk through it then. So the first step, if you know Python, get your head around some of the libraries of the Python. I call it the Python quant stack, right? So Pandas is very important. Polars is becoming a very good option for using big data analytics on your local computer. So 2-3 gigabytes of price data, Pandas starts to choke. So we want to move to Polars. And I know that you're talking about options here. Options data are a little bit tricky to get your hands on. iVolatility.com is a good source of options data, historical options data. So iVolatility.com. That's what I have used in the past. I think there are other vendors, but that's the one I've used. So you start to learn how to manipulate these data with Python. And let's say when I used to trade options, I would just do call spreads, like short iron condors. That was my kind of bread and butter. And my go-to was I would find iron condors with a net delta of 0.15 or negative 0.15. So way wide wings, out of the money. I would sell them at about 65 days to expiration, and then I would cover them when I'd have to buy them back at a loss at 150% of the credit, or with like 10 days to expiration. So how did I come up with those numbers? Well, if you're an options trader, you know your Greeks. I would create the payoff of an iron condor. I would use a model like Black-Scholes or any options pricing model to compute the value of that position over time. And when I looked at the theta, for example, which is the time decay of that options position, it started to accelerate at around 60 or 65 days to expiration, and it started to flatten out at around 10 days. So that gave me an indication, that gave me the analysis I needed to know when to start selling those positions, right? And that was a very data-driven way to analyze that position. Now, a lot of the tools that, Thinkorswim or Tasty Trade or Interactive Brokers gives you this type of analysis. So whether you decide to do it in Python by yourself or using the tools that you're given, the point is that this is the mindset that you take. So, I wouldn't get too caught up in having to use code if those tools exist for you. The reason we use code, however, is when the tools do not exist for you. So like back testing and algorithmic trading strategy, there's commercial software to do that. But if you're interested in using the open source versions, then you need to write custom code to be able to do that. So where should you get started? I mean, my course is one of the best ways to get started. I teach you all of the Python that you need to know to do this. I give you all of the templates and the notebooks, and this will give you a very, very good foundation. If I can figure out how to share, I'm happy to share that. Share screen.
if you can just send me the link, I can open it.
Okay, I'll send you the link.
Yeah, I could do it that way.
Yeah, I'm streaming this right onto, let's see, PyQuant News. Sorry, guys. All right, so here's the link to Shar, if you want to drop that in. And then there's a coupon code for you guys. So that's the sales page with the details that Tushar will put in. And then here's the checkout page. It's got the coupon on the back. So if you're interested in signing up for it, do that. I've also got a Substack here as well, which is it's a great and free way to get a lot of Python content. It takes time, I think, is also the point, Vikram, is just read the stuff, focus on it, use it every day, and it'll start to resonate. And I think my course is a really good way to get started. The workshop that we talked about is also a really good way to get started too.
Mm. I'm sharing my screen and I'm walking them through the course.
Okay, cool.
So yeah.
Awesome. So while you do that, Tushar, maybe I'll read the other question.
Just before we go ahead with the other question, I think because we're almost halfway through the session, it would be nice to take our first raffle and just complete that.
Cool.
Because there are a lot of people who've entered into the raffle. Just let me know whenever you can see my screen. I can do the first draw.
Yeah, we got it.
Perfect. So 5 people have entered the draw to win a 50% discount. Let's see who wins the first one. Congratulations, it's John Baptiste there. John Baptiste, if you follow me or if you follow Jason, one of us, please just drop us a message, drop us a line, and we'll ensure that you get your 50% discount code. Congratulations once again. And anyone else who still hasn't joined the raffle, there's a ticker going on at the bottom. Please enter the raffle by commenting hashtag Packt. And yeah, we'll pick you up in the next one. There is another giveaway towards the end. Okay, so yes, the next question, I'll share that now. Oh, by the way, just to continue on the same question, Travis says that I believe you mentioned ivolatility.com for options for backtesting. Where can I properly source historical tick level data for stocks?
Good question. I would challenge you, Travis, and ask why you need tick data. Tick data, first of all, is very expensive, and I would posit you might be able to get by with minute resolution data rather than tick data, but that's ultimately up to you. There is and tick data is pretty hard to deal with. Depending on what you're trying to look at, you can try what's called NASDAQ Total View. NASDAQ Total View is the itch. So the itch data is the NASDAQ tick data. If you go to also, this is going to sound weird, but Amazon Marketplace. So if you Google Amazon Data Marketplace, they call it the AWS Data Exchange. And in there, you can get to these data sets. So on the top, you'll see data sets, and then you can search for financial services. And then you've just got all of these data sets. So depending on exactly what you're looking for, you may be able to find it in here. I just searched for tick data, and it looks like there's a bunch of stuff coming up. And part of the challenge is that there's so much of it that it's very difficult to deal with. But that's a couple of sources that I've used in the past. Frankly, when I've ever used tick data, it was coming right off the exchange in a professional setting. I've not dealt with tick data on a retail basis, so I don't have a lot more to share for you there. But ivolatility.com is good for end of day options data.
Yeah, I can see that you've added something on the screen. Do you want me to share that as well?
Sure, if you don't mind.
Yeah.
I think people are asking. So this is a couple of the resources that I might suggest you check out. The first one is a link to the Substack, and that is, I do a weekly newsletter, free content. You don't have to subscribe, you don't have to pay. I post that every week. That's a really good source for like very practical code. The middle one is what I call Python Foundations. This is if you're brand new to Python, this is a really good way to get started. There's a 50% discount for you guys following this link. And what this will give you is, there's like 10 libraries that are commonly used in Python for this type of work. And this walks you through in a lot of detail, practical use cases and practical use of Python in this space. And then the third one is the course that Tushar was showing. It's the 20% discount there. This is a very, very good way to get the basic foundations. It's actually not that basic. It's very thorough, I should say, about the concepts in quant finance, algorithmic trading, and then the Python that you will use to go along with it. So these are the courses that I offer from free to paid, and it's a really good way to get started.
Yeah. While you're walking through it, Semi inquired, can you please share the link? So, Semi, if you can hear me, and I hope I'm pronouncing your name right, the QR codes are on the screen. The link is on the screen. If you want, you can take a screenshot of it, or if you can scan it. Yeah. So these are the links that Jason was talking about, and he's walking you all through it.
Yeah, thanks, Tushar.
And yeah, John Baptiste was the first winner, and he's really happy about that. So, John Baptiste, please get in touch with either me or Jason, and we will ensure that we get you your 50% discount voucher. The course is next week on 12th, I believe, on a
Yeah,
Friday.
12th. Yep, that's right.
Ah, 12, 12, 12th of the 12th. Okay.
Well, 12.
Yeah. All right. So, yeah, now let's pick up the question that Semi had. So, Semi was inquiring that, hello, Jason, what resources do you use to find alpha edge? Should we research books or articles? Should we examine master's, doctoral dissertations? What are your suggestions? The second question is, in which time frame and on which pairs should a strategy's initial testing be backtested? And then other time frames should be examined. It's quite a long question.
Long question. It's a good question. So source of edge, unfortunately, it's not as easy as reading a book or writing a paper, right? That said, reading books, reading papers is a very, very good way to get the mental framework, the mental model on how to think about finding these strategies. Okay. The best way to find these strategies is to actually be in the market. And you can get, paper trading accounts where there's risk free, and reading articles. For example, there's an article just this week on Substack about Nvidia. So Nvidia released their quarterly earnings a couple weeks ago. The stock rallied, then the stock tanked. And this analysis talked about the fundamentals that were discussed in the earnings call, and how high frequency traders, or algorithmic traders for that matter, were able to do the analysis on the qualitative data discussed in the earnings report, and they formed a bearish perspective in a very quick amount of time, right? And it had something to do with day sales outstanding, and Jensen Huang is up there talking about all this insatiable demand for their chips, but the numbers were showing a different story. The numbers were showing that there's actually not an insatiable demand, and the demand is slowing down, according to this author. And that's just a very interesting thing. So in that example, you would start collecting data about situations where you have found other companies in a very similar situation, doing that manual research to figure out if, in fact, day sales outstanding goes up, what happens to the stock price, et cetera, and start to experiment on whether you think there's a pattern there and an edge, right? So I literally just formed a hypothesis in my mind in real time with you based on an article I read a week ago. Most of the books that you will come across deal more in technical analysis because it's what sells. It's easy to understand. You watch your 20-minute YouTube video, your get rich quick promises, et cetera, et cetera. So that's where I find most of the books land. Again, there's nothing wrong with technical analysis. It's just not my wheelhouse. It's not what I talk about. It's not what I teach. Papers are typically very academic, and they don't actually pan out in real life. So I would kind of stay away from papers. There's an interesting blog called Quantocracy. Let me link it to Tushar here. And what Quantocracy is, it's a terrible name. I can never even spell it. Quantocracy. It's an aggregator. So this guy aggregates a bunch of blog posts from around the internet, from like retail non-professional traders blogging about their stuff. And this is a very interesting source of comments, right? So people will post, like, perfect example here, alternative market signals investing in box manufacturing index. Like, who knows what the box manufacturing index is, but who knows? Like the second one, opportunity set bias and mean reverting trading strategy. So you kind of start to find the authors that are talking about interesting things that you can start to test and run them through your rigorous process to understand if they have an edge.
Okay, I was sharing my screen and I was just showing that.
And then the second question is, in which time frame and on which pairs should a strategy's initial testing be back tested, and other time frames? The time frame is completely dependent on the strategy, right? And the idea there is, my camera went blurry. I don't know, maybe I'll flip it off here.
You could just probably wave your hand to it and then it'll come back. Yep, there. It's back in focus.
Magic.
Yeah, my camera as well.
Okay, so for example, there's a balance between transaction costs and market impact and strategies. So Some strategies are meant to be on a monthly rebalance. Like at this point, I'm busy and I'm not sitting and watching the screen all day. So I have a monthly rebalance strategy, and it's designed to be a monthly rebalance strategy, right? You
Mm.
know, the whole strategy is predicated on a monthly cadence. I also have traded that crack spread strategy, which is an intraday strategy. So every 30 seconds, I run the algorithm and look for a signal. And if I find the signal, I enter the trades. So it's really just predicated on the strategy itself. And you mentioned on pairs. It sounds like you're assuming that there's a pairs trading strategy. Typically, pairs trading strategies are looking for a relative arbitrage, right, between the two assets, or a breakdown in a consistent relationship that exists through time. So if you're running a purely statistical arbitrage strategy and you think that relationship is purely statistical, and that relationship is in flux all the time, then you would want to be checking for breakdowns in that relationship all the time. If that relationship were, like, let's say, predicated on a monthly economic news announcement, well, the intra-day and intra-month is just noise and it doesn't matter. So you only want to be trading that pair when there's an alpha event, when there's new information in the market, right? So there's no concrete answer, which hopefully you're inferring from my ramble here. It's just totally predicated on the type of strategy that you're running.
Perfect. All right. Thanks a lot for that, Jason. So yeah, if anyone else has any questions, please feel free to pop them up in the chat. Uh, what should I ask now? You've covered a lot of ground, Jason. I'm just wondering. I prepared a few questions, and we seem to have covered quite a lot of ground over here. I want to ask about beginners because there are a lot of beginners who would join the session, and I want them to feel a bit motivated. So let's talk about this one. So before building strategies, what core concepts must every learner master?
Yeah, there's not really like a checklist. And I think that's where people get caught up. They get overwhelmed because they see the 15, they see my bookshelf with all the books and they see all
Mm,
the blogs and they get overwhelmed by all the content on the internet. It does not have to be that dense and that difficult. Like, you don't need to know machine learning. You don't need to know stochastic differential equations. You don't need to know this stuff, right?
mm,
You really just honestly, this is going to sound really like cliche, but you have to have a willingness to go through the journey, because this stuff does not happen overnight. If anybody promises you that it will, they are lying to you. This is a journey of time, months, years to get
mm.
good at this stuff.
Yeah.
I would highly suggest getting yourself good at Python or R or whatever. Python is just the easiest language to learn, and it's got the most tools built in for this type of work. Okay. Definitely in the background, learn Python. That is a core competency. Okay. So I guess there are some core competencies. With the trading, a common mistake that people make, in my opinion, going to technical analysis, it's the easy thing. The charts are pretty. You can drag and drop the charts. You can write your Pine script. You think you're doing something interesting. Unlikely you will be successful over the long term. Okay.
Mm,
So learn your Python. The second thing I would suggest is find a trading strategy, just one, and just work on that as a test case, right? This crack spread strategy I've described to you. Take my course, take the templated notebook, make it your own. Tweak it, play with it, change the parameters, get your paper trading account hooked up to it. The workshop we're going to go through with Packt next week, you will be given code to run this strategy directly in interactive brokers, like live trading. It's an excellent way to start to get the intuition in the markets. That's the other thing that people miss, is the intuition in the market, right? I call it I posted occasionally on Twitter, there's a Venn diagram of three circles, right? You've got math, you've got programming, and then you have the markets. So the more experience you have with those three, the better off you are, right? If you just have math and markets, you can't execute at scale. If you just have programming and markets, you're going to get yourself into trouble. Those are the danger zones, right? So really understanding those three things, and I'm not saying dense mathematics, I'm just saying like and basic statistics and like knowing the assumptions is also probably an important skill to understand. So go back to your like your undergraduate very first statistics 101 class. Remind yourself how distributions work. Remind yourself how the t-test works, how statistical testing works. That's another kind of core competency. Now I'm backtracking because I told you there were none. So Python, statistics, get yourself in the market to start getting that market intuition. Get yourself a single trading strategy that you can use as a test. Those three things is like 6 months of work. Then what you can do is you can start expressing your views in different ways. So same trading strategy, but instead of stocks, try futures. Instead of futures, try options. Instead of options, try futures and stocks. You know, your trading will fit your personality. Maybe you don't like stocks. Maybe you like a lot of leverage. Okay, we'll use futures. Maybe you like the complexity of the Greeks. Okay, well then use options, right? Find what works for you and then express your view using that set of tools. Okay, so Python, basic statistics, find yourself a trading strategy, and get the market intuition. So those kind of four things, if you bang on those for 6 months, you'll be in a really good shape.
Thanks, Jason. And in your view, what makes an algorithmic strategy truly robust in live markets?
That statistical significance that I was talking about.
Mhm.
So, you know, the way that hedge funds trade, and I'm going to get a little dense and technical here for a second. The way that hedge funds trade is they use factor strategies. And what does that mean? So factor strategy is it's a variable that you think predicts future returns, not prices, returns. And they use alternative data for this. This is why all these hedge funds just constantly scoop up data because they're trying to find alpha factors.
Mhm.
And there's a bunch of techniques that I actually talk about in my course about how to derive these alpha factors and measure the statistical significance of that alpha factor. So how statistically significant is your prediction of future returns? That's how I trade. That's how I traded at JP Morgan. That's how I traded at the hedge fund. That's how I did all the risk management, et cetera. That's the way that funds trade. Okay. They don't pump prices into black boxes and try to predict prices. So the statistical significance of that comes back. And that method is actually very useful because you can track what we call alpha decay, right? So we've all kind of heard of alpha, but that alpha will decay over time, and you can actually quantify that. So another benefit of trading in this way is that you have a lot of data to test against, right? And the back testing process is also useful for that purpose, which I've already described. You want to test the statistical significance of your strategy. So that is how you can tell if your strategy is robust, right? You've got statistical significance in the back test through that process that I described loosely earlier, which I talk a lot about in my course. And then this process of factor analysis. And I'll give you something, guys, to put into Google. It's called the information coefficient. Tushar, maybe you just drop that in the chat. Information coefficient. Just go to ChatGPT and say, what is the information coefficient? Okay. This is the heart of measuring the robustness of an algorithmic trading strategy. Okay.
I can just probably show it. What is the information coefficient? Am I spelling it right? Efficient, yes.
Let's see what we see. I'm going to share it right, Tushar. Share screen.
You said information coefficient, right?
Yeah, that's right.
Okay. I hope I've spelled it right and it doesn't pop up random information.
What is the information?
There. Can you
There
see
you
my
go.
screen?
Got it. Yep. It's small, but we can see it. Yeah. So this is the whole idea, right? It's, you know, you asked how you measure the robustness of an algorithmic trading strategy. This is essentially how you do it. So this measures the robustness of your predictive factor. And with Python, we have all sorts of tools to make it easy to measure this over time. Okay. So this is the best way to do it, and this is how the funds are doing it. They're doing, the factor-based strategies. This is where machine learning is applied in trading. This is the place, not what you'll read about on the internet or what you'll see in YouTube. No, you can't use ChatGPT to trade. Like, all this stuff is nonsense. Machine learning is used to derive and generate predictive alpha factors, and their robustness is measured using this so-called information coefficient.
Information coefficient, that's what it is. So yeah, if anyone wants to take a screenshot or Google it, yeah, or ChatGPT it.
Yeah, perfect.
All right. I think we are done through most of the questions. I'll do my final raffle that we have. And do you want to share any information, Jason, before I do the final raffle? And it'll give people a chance to ask a final question if they have any.
No, just definitely recommend, guys, to go out, and if you don't want to pay for anything, then go out to the Substack. That's the first link there. You'll get a weekly newsletter. Just follow me on Substack, sign up for the newsletter. I'll occasionally pitch you on stuff, but I mean, it's very passive. I'm not a hardcore salesperson. I just like to publish content. The middle course is if you're just getting started with finance. This is like $150. Very practical as it relates to using Python in finance. So if you have an interest in using Python for this work, it's a great way to get yourself started. And then that third course marries these broad concepts that I tend to go very deep in with the tools that you need to use for algorithmic trading and quant finance. So this is the best way to get started as far as I'm concerned. And then we've got the workshop next week. Again, this stuff costs money. I spent $90,000 on a master's degree, and I spent 20 plus years in the industry. $200 for what you're going to learn is very good. Okay, I'm not trying to pitch. I didn't even set the price. Okay, Packt set the price, but this is very valuable stuff. You get the code to take away, and if you're looking to help, take a step in the right direction, this is a very good way to do that. Any one of these options that you have here.
Yep. Thanks, Jason. And on that note, I'll do the final raffle. Share screen and just raffle. So yeah, just a reminder for everyone. John Baptiste was the first winner, and hopefully it doesn't pick him up again. I think, yeah, I think the algorithm is it is not showing him. That's a good thing.
Vikram,
Yeah,
all right.
on LinkedIn is our second winner. Congratulations, Vikram. Yeah, please get in touch with me on LinkedIn or Jason. I'll get you your code for the course. Congratulations to both the winners. And Jason, we'll take our final query from John Baptiste. As retail traders, can we realistically compete against hedge funds and HFT firms? If so, where do our advantages lie?
Great question, and it's a common one. And lucky for us, the answer is yes, but we just play a different game. Okay, we are not competing directly against these funds. Like high frequency trading, for example, is a hardware arms race, right? They're co-located servers, 10 millisecond latency to the servers. And that is the trading strategy that they implement, right? There are high frequency arbitrage strategies, essentially. That's not what we're playing. So the broader question is, how do we compete, or why do strategies exist in the market that are not traded away, okay? And it has to do with the friction that is introduced when institutions try to trade a new strategy. So there's something that institutions worry a lot about, which is the capacity of the strategy. So famously, Renaissance Technologies, obviously one of the single premier fund ever to exist, right? Jim Simons, guy's a legend. They returned money to investors, and they keep their fund at around $15 billion because the capacity at which they trade. If they start to increase the capacity in that strategy, the edge diminishes, and the opposite is true as well. So they are optimizing for capacity. This is true of all strategies because an institution has sold a product to investors. That product is returns with a given volatility level, right? Risk-adjusted returns. and they need to continuously deliver on that promise, which is a certain level of risk-adjusted returns. And if they attack a strategy that reduces, like the returns diminish because of the capacity constraints of that strategy, then they won't enter that strategy because they have to have consistent risk-adjusted returns as their product to their investors.
Hmm.
So that is the thought process when researchers are looking at a new strategy. So my point in saying this is there are various friction points that exist that prevent institutions from trading a particular strategy, and that is where we play. An example is a momentum strategy. Okay, so over the long run, stocks go up. Okay, and that sounds fine. Obviously, you have to outperform the benchmark, so you can't just buy the S&P. But the problem with momentum, and momentum is a known anomaly, right? So it is a known asset mispricing. So is mean reversion. So the question is, why do these anomalies remain in the market? Why aren't they being traded out from institutions? Well, the answer is friction. So in a momentum strategy, you will have over the long run very good returns. But over the short term, you will have very bad drawdowns. An institution cannot have a drawdown for a year, 2 years. What happens to an institution if they have a 2-year drawdown? They get fired. This is known, right? So in their analysis, they're like, okay, over the last 60 years, there's been several periods of 3-year drawdowns. We can't engage in this strategy because we can't have a 3-year drawdown. We will be fired by the pension fund who is investing with us. So that is a friction point for that investor or that institution to get into that strategy and otherwise squeeze out that alpha. And that presents an opportunity for us.
Perfect. Thanks a lot for that, Jason. And so, thanks a lot, everyone who joined in. Thank you for the winners, Vikram and John Baptiste. Please get in touch with either me or with Jason, and we'll get you your voucher for the 50% discount on the course. Once again, these are the three important links that Jason has been talking about. Uh, Please subscribe. Take a screenshot of this or scan the QR code right now while it is on screen. Uh, Jason, any closing notes while this is still on screen?
No, thanks, guys. It's been a pleasure. I'm looking at Twitter, and there's 725 people on the event. So thank you all very much. Look for me online. I'm a pretty easygoing guy. If you have a question, just ping me on Twitter, ping me on LinkedIn. Sign up for the Substack, and I'm happy to help. And looking forward to seeing you guys out there.
Yep. Thank you, everyone, and have a nice day and enjoy your weekend.
Cheers,
Yes.
everybody. Take
Bye.
care.